apologize for being late. We had met, I think, early June, I believe it was. And so I tried to update this, but a little bit of a refresher, and couldn't remember exactly who was in that first presentation, so I thought maybe we'd just start over briefly. And as you know, you have about a $24 million unfunded liability, which is the topic of the conversation, which for 2016 produces a annual retirement contribution, which we call an ARC, of just under $2.9 million, which is down from about $4.2 million in 2015. Most of that reduction in the ARC is due to the fact that you deposited $10 million into the plan in the middle of 2015. The unfunded portion is approximately between $2 million and $2.1 million. So what we're addressing in this conversation is the unfunded portion. You will always have what we call the normal cost, which is the difference between the 2.86 and the, call it 2.1 million. Somewhere between, it's about $750,000, which regardless of what you do, will always be there. We would expect, given market performance, that the unfunded liability for at the end of 2016 will certainly not be less. It is likely to be a little higher, but we'll see what happens when the actual asset plan is produced a year from now. One of the most significant assumptions in the actuarial pension plan is that the plan assets earn 7.5% every year. So that is essentially your cost of borrowing that $24 million unfunded portion, because it's supposed to be earning 7.5 and it's not. So the liability is accruing at 7.5. To the extent your plan on average earns more than 7.5, you are eating into that a little bit. But when you look at your mix of equity and fixed income, about call it 65-35, and assuming in this rate environment that fixed income is not doing 7.5%, it really means your equity portion of the plan has to produce more than 10-11% every year just on average to get to that 7.5%. We see that when you look back at your 10-year average of about 6% average rate of return in the plan, and what most people are saying the market holds for the future. We see double-digit equity returns as being pretty challenging. And so again, the net result of that is you're funding the unfunded liability at 7.5%. And so the question and proposition is there a less expensive way to fund that unfunded portion, at which you said, okay, let's go find out whether or not there is. So we had contacted some local banks. We received two proposals, one from Fulton and one from Integrity, which is now S&T. And we had conversations or dialogue with two underwriters, one being RBC Capital Markets and the other being Stifel Nicolaus, which is also your plan asset manager, or at least manager of managers. And actually got some very compelling results back. Fulton Bank offered a fixed rate for 7 years at 3.6, with a cap at 5.75 for the remaining 13 years over a 20-year period. If you want to extend this to 25 years, then the cap would extend to year 25. If we stay in this rate environment, obviously the reset in year 8 would be lower, but because we don't know, we have to calculate numbers based on caps. We got a proposal from S&T/Integrity with a cap at 571, but also a higher initial rate, so it was a little less competitive than the Fulton proposal. The most compelling funding option came from Stifel Nicolaus, and over 20 years it's about 3.9%, over 25 years it's right on 4%. So the difference between, call it 4% and 7.5, 3.5 basis points, over 25 years produces a net present value benefit of a little over $10 million. So on a $24 million, call it borrowing, the present value benefit over 25 years is almost half of that at $10.4 million. We kind of fooled around with how you would employ all that, because if we do this financing between now and the end of the year, or more importantly before you make the 2016 ARC, you would have the unfunded portion of the 2016 ARC that we could use to downsize the issue. And so we looked at that and said, okay, what's the best way to employ that along with your existing debt? And as you recall, you're out of debt in a few years, about 7 or 8 years. And so we looked at this as, what we call a quasi-wraparound, where we would defer some of the principal for the first few years. DCD will allow a few years of that, and essentially use that $2 million to offset principal payments in the early years, and then it gets fully loaded. And then as your current GO debt drops off, then you would just have just as pension obligation debt. And so I'll start with that one. Just, this gets a little confusing because it's a lot of numbers, but I thought it would be helpful to see it on paper. So the left column, far left, obviously, is the fiscal year we're dealing with. And the annual retirement contribution is the unfunded portion. And we had, because I'm not an actuary, I had actually asked an independent actuary to calculate these numbers for us based on all the assumptions in the plan. And so you can see that the unfunded portion is approximately $2 million through 2023. Then it drops for a few years, actually hits an unusual low point in 2028, and then it starts ramping back up, and it gets as high as $2.8 million in the last 10 years. Now, if you were to smooth all that out, it would be approximately $2.1 million a year, I believe. The second column then is a debt service payment on essentially a $22 million borrowing, assuming that you would take the $2 million that's in the budget in 2016 for the unfunded portion and use that to downsize the loan. And so then the corresponding debt service payments, principal and interest, from 2017 through 2041 are listed, and we show a debt service payment of $2 million in 2016 because we're essentially using your budgeted money this year to downsize the loan. The corresponding savings or reduction in pension contribution then is the next column. We describe it as savings. And call it $780,000 through 2022. Divs, and then it goes, starting in 2030, goes back up and rises significantly. So over the life, you save almost $21 million. In our world, we express everything in present value dollars so that you can compare one option to the next with some validity. And the present value of that $20.99 million at a 4.5% discount rate is almost $11.4 million over 25 years. We picked the 25-year term in this particular example because that matches the amortization of the unfunded liability as it exists today. So if we get to the end of 2016 and the unfunded liability is larger, all those numbers in the first column would change because the numbers get adjusted and potentially extended as the unfunded liability might grow. To the extent that the market outperforms the 7.5% assumption, the term of that unfunded liability would not shrink, but the dollar amount would shrink. And I'll stop there. That's a lot of numbers. Yes, ma'am.
Yeah, I have two questions up to this point. Who was the independent actuary?
Used to be called Municipal Finance Partners, I believe is right, MFP. But I believe the guy who runs it actually changed it to his name, which I think might be Charles Friedlander Actuarial Services or something like that. But I'll get you the exact name.
And the cost of this actuarial plan?
Zero, unless you decide to do something. All I did was give him your plan as prepared by the Hay Group and said, can you tell me what it would cost year by year, all other things being equal, to fund the unfunded liability? And the all other things being equal is all of the salaries go up as the plan forecasts, all of the employees retire and or pass away on the actuarially determined dates, and that the plan earns 7.5% every year, no more, no less. So everything has to work in the model, with the only variable being how do you fund it.
Okay, then I guess my last question at this point would be, and this is a very sensitive question because I highly respect our investing overseer firm, but sometimes putting all your eggs in one basket is not the wisest thing. So if they would also be funding it, is that a wise decision?
Well, the funding is selling bonds in the marketplace, so you don't have a liability to that firm, and you certainly have the ability and authority to reject whatever they tell you they can sell in the marketplace. So, for example, they've given us indicative rates and spread to treasury rates across 25 years with the understanding that if the day they come to market and what they represent by way of a contract to you isn't what they've represented to us by way of communication, we don't have to accept it. So the county doesn't incur any liability just because they would be the underwriter. They really are just a broker in the middle of you as the borrower and investors on the other side who are essentially lending you the money over the term. So your contract over the 25-year term, or whatever term you choose, would be with the investors, not the underwriting firm. They are strictly a placement agent. So it neither heightens nor lessens your exposure to your asset manager. And to the extent you're not comfortable with it, I mean, you don't have to use them. They just produce what we thought was a very attractive alternative. And so we thought that was, you know, given they showed interest, I think it was March when they came in to make a presentation.
Yeah.
They've been very proactive in communicating with us, and they actually gave us a better proposal than anybody else. So that's the reason we're not telling you who you have to use as your underwriter.
We've been using RBC Capital for years.
Yes.
And this is literally giving them competition by
Yes.
by asking someone else
That's
to give us a
correct.
price.
And there are a lot of ways to deal with that, but it's your choice. If you're uncomfortable with the asset manager being the underwriter, that's your decision. We were just trying to find the best option. And so this really comes down to, you can, you know, do the pay-go, as we say, as determined annually, and it's an embedded cost of 7.5%. Because we've had such a significant drop in particular Treasury rates of the United States government obligations, the ability to fund it at significantly less than 7.5% exists today. And we reached an all-time low in the 10 and 30-year rates a week and a half ago. So we are still at what are, by data points, all-time lows in Treasury rates. Because this is a taxable obligation, it would trade in the marketplace akin to a Treasury obligation. So we do have some other options to kind of simplify it a little bit. If we did the same 25 years and we just did level debt service, the benefit is a little higher on a present value basis. It's about $10.4 million. So it's, you can shorten the term to 20 years. It's not matching the term of the unfunded liability, and the easiest apples-to-apples comparison, as we say, is to match terms so that nobody can say, well, it's just less expensive because you shortened the term. I really view this as, you have a long-term mortgage at a rate and somebody's telling you can refinance at a lower rate. Do you want to take that opportunity? We don't see this as creating more risk in the pension plan. You have about $100 million invested, so at a 65-35 mix, $65 million is in the equity markets. If we took this $24 million and did the same split so that you didn't disrupt your asset allocation, you would be putting approximately, call it $14 million into the equity market, so it would go from 65 to, round the numbers up to $80 million. Still maintaining the discipline of whatever your asset allocation model is as determined by your asset manager of managers. If you thought that it was the wrong time to put more money in the equity market, you could certainly skew that allocation and put all $24 million into fixed income. That would get you closer to probably 55-45.
So the investment policy would have to be...
You would have to amend your investment policy, yes. Yep. So there are ways to deal with what you might perceive market risk to be on that deposit. I certainly wouldn't suggest, from my opinion, that you would just put it into cash. I think you would want it employed in either the fixed income or the equity markets. But I'm not your asset manager. That really is a conversation to be reserved for their expertise. I just, we view cash as kind of a dead asset in the marketplace today. Going back to the presentation then, there's a page that looks like this, and I apologize they're not numbered, but the title is Unfunded Liability Payment Options. And we looked at 4 basic options, and that certainly isn't the limit, but it was a good place to start. As I said earlier, we looked at 20 and 25-year level debt service like you would have a home mortgage. And then we looked at the same 20 and 25 years, but using the $2 million of budgeted 2016 unfunded ARC payment to reduce the loan from $24 million to $22 million, which would allow us to reduce the principal payments in the first few years, so that in the aggregate of your current debt and the proposed debt, it would be a little more level than just laying $24 million of level debt service next to the existing debt. Your current debt is approximately
$24.5 million.
Outstanding debt, 20 million.
Your existing debt through 2022 is about $2.8 million a year. Then it drops to $1.6 million, and then you have virtually no debt from 24 through 31. So this was an attempt to even it out a little bit, but still comply with the requirements of the Local Government Unit Debt Act. We have to submit this to the Department of Community and Economic Development for approval, and they've got their view of what debt has to look like. Again, you know, we look at present value savings of more than $10 million as certainly an interesting conversation. You are authorized under the Local Government Unit Debt Act, which they amended in 1994 to allow for pension financing. So, you know, unlike other projects you've done, this would not finance a capital asset. It would finance a contractual obligation to fund an asset plan that is currently underfunded. It doesn't count against your borrowing capacity, so we would not be consuming your ability to finance, you know, in whatever year a new prison or, you know, whatever infrastructure the county would have to undertake. Again, it would be a fixed obligation, so it would not be subject to interest rate risk. You would not be subject to credit renewal risk. So once you sell bonds in the marketplace for 20 or 25 years, it's a fixed obligation. The investor bears the interest rate risk, meaning rates might go up and the investment might not look so good. They also bear the credit risk that, you know, in the future the county might not be rated as it is today. It might be a lower rated county. So the point of that is we're not asking the county to incur either interest rate risk or credit risk in this. It's a fixed obligation. You would have a contractual obligation with the bondholders to make debt service payments on an annual basis, which is arguably a little different than your pension obligation, which on one side is a contract with your employees and beneficiaries, but not a contractual obligation to fund. You accrue the liability, but you're not obligated to fund it yet. That's probably coming. The next steps, I guess, well, I would go to, the questions we get most common are, you know, what if the market goes down? And you've heard me say this before, but you have $100 million in there today. The amount that would be going into the equity market, which most people think your exposure is on the same asset mix, would be less than $15 million. So it's not, on a percentage basis, a huge change to an asset plan that presumably you're comfortable with today. But it would be, again, along the same 65-35 asset allocation, unless you go back and amend your investment policy along with the advice of your asset manager. You know, we do have some clients, and we have one right now that is saying, well, I haven't earned 7.5% in a long time. Should I change that assumption to 6 or 6.5 to more closely match what I've done historically, recalculate my liability and finance it? That is an option. We would have to have the Hay Group redo the plan. I can tell you just by comparison to this county that's looking at doing that, if you dropped your assumption from 7.5 to 6, your liability would go from 24 to 32, 33 million. So you'd be financing, what is that, an additional 10 million, almost 50% more to drive the asset assumed rate going forward down to your 10-year average. The last 5 years, I think you've averaged pretty close to 7.5, but over 10 years, it's just a tad under 6%, which is consistent with balanced plans. That's not out of line in the marketplace. So again, I'm not the asset manager, and that, you know, probably is a conversation you'd want to have with them. They might have a different idea of whether or not you should be throwing another, you know, 14 million in the equity market or in the fixed income market. But we don't see your risk profile is really just put in 2015 was deposited proratably within the asset plan.
Yes. Excuse me, John.
Yes.
I want to back up before you get too far
Sure.
into the slides there. Let me back up a couple of them. The one that has the 4 bullets, and the last one being the county would continue to receive reimbursement as if the plan was funded at 83%.
Yeah, so the methodology we've been using, which was blessed by the Commonwealth, is that you would essentially issue a second report. I don't know if I have an example of one. But the second report, which we call a shadow report for lack of a better descriptor, says that you didn't put the 24 million in and it's still underfunded, and the unfunded liability is calculated, and you receive your reimbursement as if it were done that way. And so here is, this is, as I think I mentioned this to you, Clinton County did a pension obligation, and they do it 2 ways, with pension obligation bond, without pension obligation bond, to derive at the, what is considered to be the net pension cost to the county. And they do it for 2 reasons. One is for reimbursement, and the other one is to track on an annual basis as to whether or not they're actually ahead of the game. I think they did their first one in 2005, and I don't think there's been a single year where by actuarial determination they weren't better off with the funding, meaning they were better off having done the funding as compared to not doing the funding. So it really serves two purposes. One is to justify the reimbursement, and the other is to just give them a running baseline of, was this the right thing to do?
So the reimbursement we would receive, is it just on the normal costs, or is it
No,
on
because
the
right now
entire amount?
it's on the entire amount.
Okay,
yeah.
so are
you
we-
would continue to receive reimbursement on normal costs. That's not going to change,
Right.
Unless you have a significant change in your labor force. Then it could go up or down.
Okay.
But the unfunded portion then is subject to reimbursement. If
And-
we fund it, and that's all we issue, you lose the reimbursement on the unfunded piece, because it's not
So-
a payment you're making.
Okay.
So the Commonwealth looks at your pension, actuarially determined pension obligation. They don't look at how you're funding it.
Yeah.
Does that make sense?
Well, so if we were to do this would actually potentially save the Commonwealth money as well.
Well, I don't know that we tell them it saves them money.
Well, I'm not suggesting.
Yeah, I don't
I'm
think
just-
it's.
well, I'm not trying to be
Yeah, I guess
funny, and
over,
I'm
I
just
guess
trying-
over time it saves a little. Their only concern is that they're not paying you more. They're not concerned about paying you less. They're concerned about paying more. Because their attitude is, if I don't pay you more and you do something, so what? I wouldn't expect you to take less because you're borrowing the money. You're funding it. So their attitude is, I'm willing to pay what I was going to pay.
Okay.
This obviously would bring you up to 100% funding. Our conversation with Standard & Poor's is that whether or not you fund it, they view your pension obligation as a long-term obligation, and in their words, a long-term obligation is the same as debt. So, today you have a pension obligation, maybe in the future OPEB gets converted to the same thing as they continue to refine accounting standards. But they look at any obligation you have like this as a long-term obligation. They don't care if it's a contractual obligation with investors or it's just embedded in the pension plan. They view it as one and the same. So when we present to them and say, well, we're funding at 4, not 7.5%, they view that as, well, you're saving money. That was a good management decision. It's essentially a credit neutral. You're not going to get a gold star for having borrowed this at 4% versus 7.5%. Nor are you going to get a black check mark because you borrowed it and you now have a fixed obligation.
So they don't distinguish that, and I'm not, I don't want to be characterized as chasing Standard & Poor rates, but.
Yeah, and nor do we, by just trying to give you an outside
Right,
perspective.
but if, they don't distinguish soft, obligation or debt.
They view it as an
It's
obligation.
just, we owe it on
Yes.
our pension, or,
Yeah, where they do take very keen notice is if you pass on the obligation to fund the soft obligation. That one gets attention. Because that brings them back to, you're not running a structurally balanced budget, and that is in this environment, that's the biggest negative grade you can get at the rating agency, which is a structurally, an unbalanced budget.
Gotcha. Thank you.
These are legally, this is a legal investment and borrowing proposition. Certainly other counties and municipalities in the Commonwealth of Pennsylvania have done it. Berks County, Bucks County, the city of Lancaster, Clinton County actually has done it twice. Not to speak negatively of them, but I think they actually funded it once, skipped a few years, funded it again. I don't know why.
They financed their obligation, did they skip their arc?
Then they had a couple tough budget years, so they skipped the arc, ran another unfunded liability, borrowed it, did another borrowing to bring it back up. to
Which
fully
county was
funded.
that?
Clinton.
Well, this is several years ago, I spoke to one of the Berks County commissioners, and he was bragging about how his pension plan was 100% funded, and I never delved into it
Yeah,
to
well,
find out.
that's why.
That's why.
Jay,
Yes.
what you just said goes to my core argument that they funded it, they skipped some years, and then they funded it. That can happen in a transition with new commissioners. We can't obligate them legally with debt.
Well, actually, yes. So in government, if you incur debt, you have obligated the future administration. You don't obligate them to the ARC if you do the pay-go.
That's what
But
I'm-
once you enter into a debt obligation, every future group of commissioners is obligated. The investor / lender has legal recourse if you don't honor that contract. And maybe I misunderstood your question.
Yes, you
but it
did.
is, you have
What happens is new boards may not honor the commitment that we have to fund the ARC. We have no written plan that we have adopted formally, and there's many things that belong in there. And this is a small piece, and by itself, it does not give us longevity. It needs to be part of a larger written plan. I can't remember all of them that they recommend be included. It's not enough. We need to have the big picture.
That's a little out of my purview. I wasn't asked to address the big picture, so I would leave that to, if you want us to be a part of that conversation, we're happy to be a part of it, but we've not been asked to look beyond the pension funding as you consider this.
I'm just confused about the ARC is what Commissioner Litz is worried about future boards not honoring.
Right, that's
It has
optional.
nothing to do with the 20 million that we may refinance in a bond, which would be a debt that we would be obligated.
Absolutely, there's
And
no
future
skipping.
boards would be obligated to.
Absolutely, yeah.
So-
I didn't mean to suggest
Oh,
otherwise.
right.
That was.
No, but that's what I got out of that, but the ARC then would be much smaller because we've moved money over here so that they're.
Yes, so if you fund the unfunded liability with what we call pension obligation bond, that is a contractual obligation. Then what becomes elective, or soft as people call it, would be the normal cost, which right now is running about $750,000. And we would expect that, and I don't see you changing the labor force dramatically, so we don't see that number changing by a lot.
Unless they would change legislatively the defined contribution.
Right, that's correct.
To be clear, as in the case with Clinton County, if future boards do not pay the ARC, then they go and borrow more money because they're back into the same situation they are before the original money was borrowed. That's where it becomes the unfunded liabilities.
Yeah, so the portion that they funded in '05 became contractually, they were contractually bound to that. So what they passed on then became, a couple years, so I would imagine '05, probably coming out of the '08-09 recession / market crash. The plan probably was underfunded given market returns, and they probably passed on that. I don't know all the details, but they actually did a second one then to cure the second. So it wasn't all passing on it. There was some market embedded losses, which is the same risk you would have here. Funding the $24 million does not assure or ensure that there aren't market losses going forward. You're always subject to market risk in the asset plan. That doesn't change. I guess the last point was, there was an article that was provided that suggested it's a Ponzi scheme, and to be clear, a Ponzi scheme is clearly illegal, and it is taking one investor's money to pay the previously registered investors. So it'd be like me saying to Jamie, I'll promise you 10%, but I'd already promised Commissioner Ames 10%, so I take his deposit and I pay all the commissioners to get your 10%. I've got to get the next guy in to pay his percent because I don't have an underlying investment vehicle or strategy. All we're doing here is providing a lower cost to finance your contractual obligation to fund the plan for the beneficiaries. But I don't want anybody to think that we would come to you with an idea that was not passing all of the federal, state, and local legal requirements. I think, we have, a very attractive funding option, frankly better than we were expecting, and certainly a couple to choose from. Based on the information we received, I do think the Stiefel Nicholas was the lowest cost. Again, if you have a concern about who is handling all of the pieces of business, we certainly can find other people. Our objective and hope would be that we can force them to the same market level rate as Stiefel Nicholas is proposing. If they get in the market and they can't produce what they promised, we have no obligation to pull the plug. We can always go back to a bank financing that is close but not quite as good. The reality is we took the worst case the bank is offering and compared it to the best case that the investment banker is offering. So, on one hand, we have a worst case and a best case, and we would want to make sure the difference in those is enough that when we get into the market, that if it's not exactly, what was presented, that it's still of enough benefit that it's worthwhile, but it would be part of the evaluation process if you want to proceed. Second then would be, if you want to proceed with this, we would combine the tax exempt refinancing with this to get some economies of scale out of the professional fees. I would not want to do two separate financings within weeks or months. That would be foolishly spending county money.
So in order to combine those, what kind of timing has to take place?
We
here?
would, if you made a decision you wanted to do this, we would come back and amend or just offer a new parameters ordinance so that we would include both. And, we've already started the process. It wouldn't take much to add this to the scope of what we're doing and get it to the rating agency. On our side, we can probably move faster than you would get to a public meeting to discuss it.
So then, this portion of it would not count against borrowing.
It does not count against your borrowing
And the other
capacity.
still does.
And not that you're up against it,
No,
but just to be clear,
far
because
from
this
it.
is, I think Commissioner Litz had pointed out, this is as much money as you have currently borrowed. So I didn't want anybody to
Right.
think that, if there's significant 911 or, criminal justice needs in the future, that this would stand in the way of that. It would not.
Right. And it would give us an opportunity to either help with some of those IT or some of those costs that we may, that we have in the planning stages.